Stop music can mean only one thing. We've got Let Me Explain with Chris in the house. Chris, welcome to the show.
Good to see you again. We missed you on Sunday night, Tony.
Thank you for the very kind words. I missed you too. I'm sorry my plane got in a little bit later than that, but I'll be back next week. Bells on, they say. Bells on my feet, walking. Can't wait. I missed you too, Thomas.
I didn't miss him for one freaking second.
You know he did.
Not even close.
Who goes to Florida in the summer, though? Wasn't that a nightmare? So humid.
Chris, when I know you have children, but when your children go to school and you will no longer have the luxury of just going whenever you want to go, you will start doing things in times when you will not be optimal times to go. So I can only go away during the summertime.
Fair enough.
Yeah.
I work him like a dog.
And he works me like a dog, too. And Tom takes all the premium time off, so, I'm just left with the scraps.
Fair enough. I wonder where that leaves people like me.
Oh, you're screwed. You're screwed. Well,
gentlemen, it is the Tuesday before another one of our high holy days in Macroland. We are getting ready for the CPI report. Apparently, as Vanetta calls it when she's talking about me and my obsession with CPI. So I'm just going to roll with that ton of own the badge of honor. It's coming up this Thursday, 8:30 a.m. Eastern, 7:30 Central Time. And it's probably going to be a unique print because it could be the first time that we've seen a rise in the headline CPI since May 2022. The May 2022 to June 2022 report, you get your last bump higher. And ever since then, CPI has been coming down little by little. And there are two reasons for this, perhaps why the market won't be so concerned. First off, there is a bit of a statistical base effect here. We're rolling down the hill of CPI now, which means it's going to be a little bit more difficult to achieve those significant moves lower simply because the data is starting to show a weakening uptrend. In fact, now that we're going through a period when we look at the base period from a year ago, the uptrend itself was weakening. And so we need to do a little bit more work, a little bit more heavy lifting now in order to get that next percent lower to get down to our 2 handle. So that's not going to be a surprise. The part that may surprise people, though, is how big of a bounce we get. Tracking for the CPI is coming in at 3.4%. That's right around the consensus estimates of 3.3%. And then the August data thus far is pointing to a reading closer to 3.8 or 3.9. Now, I suppose this could be problematic for markets. Headline inflation's running higher again. Is the Fed done? Oh, no. But on the other hand, this information is all well known to everyone. I don't necessarily think that a hot CPI print later this week is going to be a death knell for bonds once more, or even for the market itself. After all, the Fed hasn't relented on its ability or desire to continue to raise rates here over the near term. They haven't told us that victory has been declared. So this can cause a period of discomfort for the markets, but I don't know if I would treat it as anything more than a binary event that produces a short-term move, because whatever happens in the CPI print this month can be erased in the next one before the September Fed meeting. I'm really interested in the state of the bond market as a result of this. We've seen bonds starting to move off the lows after last week's shock. 50 basis points in the 30 years, nothing to shake a stick at, of course. But the probabilities here, the pot odds of this being the low for the year in bonds, I think are actually pretty good. We're looking at two things in particular. First off, market measures of inflation break-evens have jumped to 8-month highs, and they've effectively done that while gasoline prices have moved up to 8-month highs here. The other part of this is that longer-term inflation expectations, the five-year inflation swap forward, they're now at their highest level since May 2022. That seems like an overreaction. Do we really think that inflation, as it stands here in August 2023, is in a situation akin to where it was the month before the peak last summer? No, that is too far, too fast. So I've been looking at ZB. I know Mike Butler has as well, looking at put spreads down here. And so I'm curious about your take. Explain to me, if I'm trying to be a bond bull down here, what's the best way to play this? Should I just go about it through simply selling put spreads, or maybe a different manner?
Okay. So
now bond volatility has uptick. IB rank of 28 now in bonds is significantly higher than where it's been in the last couple of weeks, where it's been in single digits.
Yeah. So first of all, I've been a bond bull for about a week. We're pretty close. Are we back to even? I don't know. We're pretty close to back to even. Mm-hmm. I started selling puts when bonds broke under 125, 124. And this is when they were trading 127. I did 126. I said if they're getting on 125, 124, if they get underneath that level, I kind of like the long side of bonds. I never thought they were getting down to 120. So we started selling the 121 puts when they were about 20, 25 deltas, and the bonds were about 124, and we sold them all the way down to 123, 122. They've taken a little premium out of this week. But for me,
Well, time's gone by.
yeah, time's gone by. But for me, the most important thing about trading, or one of the things about trading bonds that's different from trading, we've seen a bond market basically crash up in like 2013, 2014, but we've never seen a bond market kind of crash down. It's weird. So for some reason, bond puts trade strange. They always seem to trade a little cheap, not like equity puts, which trade crazy rich. So for that reason, it's almost like trading puts. Like you trade a lot of commodities, Chris. It's almost like trading puts in like corn, wheat, or soybeans, or natural gas, or even crude oil. The downside doesn't trade the same as the upside. Doesn't have that
Currency
kind of
is same way.
yeah, currency is the kind of the same way. It doesn't have that same kind of velocity, like mentality built into it. So I actually like selling. My favorite way to get long bonds is to sell puts. I don't like the put spreads because those things trade a little cheap for me, and I think they're hard to squeeze money out of. I prefer to sell puts in the bonds, and if you don't like the bonds because they make you nervous, then I would use the notes, the ZN. You can't trade the ZTs for puts because they're just the options don't trade. But the ZN and the ZBs are literally one tick wide, and they're one tick wide day and night, and you tend to get filled, at your price on the if you leave it in on the offer eventually, they'll be cyclical enough to probably get filled. So my preference for trading bonds is to sell puts in ZB at about the 20 or 25 delta, or sell puts in ZN at around the 25 delta. That's my preference. The models are all the same. We happen to have offsetting positions right now because we're short puts in the bonds, but we're also playing the steepener of the yield curve, which tend to be moving exactly in opposite directions. I didn't think they would, but they tend to be offsetting each other. So we have this position right now where, like today, we're making money in the bonds, we're losing money because the yield curve is flattening. And so it's just weird the way the tape action is. But just getting back to bonds, and there are sort of two completely different plays. The yield curve is completely different than playing bonds directionally. There's not enough premium in the bonds right now. The volatility is too cheap to be selling strangles or skewed strangles or iron condors or any of that kind of stuff. But if you want to get long the bonds, the cheapest way for dollars at risk is to sell puts in ZB or sell puts in ZN. The TBT is a vehicle where you can get smaller, but the problem is it's a lot less liquid, and the capital required is significantly greater because it's an SEC product. The bond products, you get about 6 times the notional for the same amount of money as TLT. That's the only difference. So from a trader side, because I think we need to tie everything back to trading. From a trader side, bonds are one of the products that you really have to, trade futures options on. It's the same stuff. You want a smaller one, you trade ZN. And if you want to trade TBT or TLT, go ahead. But just know that they require more money and they're a little less liquid.
Yeah, the capital efficient play for a trader is to head over to the futures market in this kind of situation. I'm seeing the bond market as, we talk about the potential limitation for some downside here. And this all goes back to the notion of convexity between bond prices and bond yields, which I suppose might be worth doing a whole other, let me explain on in and of itself. But we're entering a territory where when you take a look at the yield structure itself, forget the bond prices, you're bumping into some really significant levels where, can the 2-year yield break through 5%? We really haven't seen any compelling evidence to suggest that it needs to do so because the Fed may not need to do more from here. What about the long end of the curve? Do we really think that we're going to go to a 4 or 5% yield on the 10-year? And the answer to me is, quite frankly, no in the very near term, because there's a lot of negative growth things that are coming down the pipeline. We've been living through a soft landing thus far, but when we think about how the economy's been evolving, the changes in consumer credit, the restarting of the student debt loan program next month, that's going to suck $12 billion of spending out of the economy every month moving forward, plain and simple. And so there are reasons to think that we could be looking at weaker growth as the year comes to a close. And quite frankly, that means that some of that growth premium needs to get sucked out of the long end of the curve. It's part of the reason why I really don't like a steepener trade right now. I want to play the steepener when it goes back to, normal type of situation, when we get back into positive territory. We're no longer inverted.
So that,
and right now, as long as the Fed's doing what it's doing, I don't think the odds of that are particularly high.
no, but that's typically where where somebody like you or I will get into, a battle over, not a battle, but a healthy discussion over trade logic. Like for me, trying to time something like a yield curve trade, something like a pairs trade, and that kind of stuff is impossible. And trying to macro time it is, you'll end up banging your head against the wall. I believe that there are certain things, like in trading, there are certain reasons why. See, I love active trading. I love actively participating in the markets, because active trading has been what I've been doing for my entire career. So I absolutely love it. But there are certain things about, kind of the more traditional way of just taking a position and, keeping it small enough that you're not gonna pull your hair out, but just riding with it, because there are certain things that are, you just think, hey, you know what? I don't even want to try to time this. Like I have tried to time pairs trades before, like a yield curve trade, like a NASDAQ S&P or NASDAQ Russell or that kind of stuff. And I will just drive myself crazy, because it just, hey, if I believe something is like there's a long-term opportunity there, I'm going to do it. I'm just going to do it. And you know what? Most of the time we're right eventually. So the key for me with trading, and this is where I differ from like everybody else in this business or most people, the key for me is put yourself in a position where where the position itself allows you to extend duration, because eventually, between cyclicality and just gravity and math and everything else, we're all kind of right at some point. Like everybody can claim they're right, basically.
A good chance to manage a winner, right? If you're putting on a trade with a high probability.
Sure. The simple thing is, if something has a 50-50 chance, there's 100% probability that it's going to touch some number that you think you're going to get to on either way. And because of that, I think the key that most people miss about trading is really about duration more than it is anything else. It's don't put yourself in a position where you get forced out of the trade because you don't give yourself enough time to be right. And that's really one of the huge takeaways about trading that I think most people don't get.
That's actually been one of the constraints for why I've been avoiding the steepener right now, quite frankly. It's that because I don't feel like I have a good timing on it. Do I want to put capital into a position that may not work for me right away, when there's other things that have been, like what's going on in energy markets right now, or what's going on with some of the energy ETFs? Why would I not want to put money somewhere where it's already working rather than just get it tied up? So for me, it actually has been a little bit of a roadblock, where I don't want to just wait around for something to work perhaps 2 months, 3 months, 4 months down the road. I may have missed the boat on it as a result. And so point taken. Tom, I know we have 2 minutes here, so I want to jump on over to something else, which I know you are deeply, keenly interested in. It's time for an update on LK99. We talked about this last week, this new superconductor material, theoretically, this lead cup rate that's coming together, and researchers in Korea, the United States, Europe, China, they're all working on it. The probability markets, the betting markets, are showing us that the odds of this actually being something real are dropping fairly precipitously. Only about a 9% chance, according to betting markets, that LK99 will be revealed to be a superconductor itself. One of the words that's being floated around is it's exhibiting ferromagnetism, which basically means, kind of like iron, it has a high susceptibility to get magnetized and stay magnetized. And so the levitation that we're seeing is a result of the simple ferromagnetism, not because it exhibits some sort of unique properties around magnetic flux fields or what have you. And that's heartbreaking in a sense. I know, Tom, you were saying, well, let's wait to see what happens. Tony and I were geeking out a little bit about it. I suppose then that means we need to turn our attention back to the other big boom, the other big technological boom that's happening right now, which is AI. I couldn't help but notice Apple this week, or rather last week, said that they really haven't been doing anything with AI. CNBC ran a headline that Apple mentioned AI 0 times in their earnings call. And the market seems to be punishing them in a little bit of a unique way. Apple stock is getting absolutely killed here the last few days. So I wonder, gentlemen, when there is a fad making its way through the market, is it toxic for a company to effectively ignore it the way that Apple has? Can that be problematic in some investors' eyes? Because it certainly seems like it is.
I like the subject line. I would say no. I think Apple made a very conscious decision not to jump on the overhyped bandwagon because it wouldn't have looked real. Like, Apple does not have the luxury of, Apple is the most closely watched stock in the world. It does not have the luxury of bullshit. Like, they can only go so, like, they just can't tell a story that's not, that they can't back up. Like, there's lots of firms out there that can tell you what they're thinking of doing, what they're planning to do, all that kind of stuff. Apple can't run that risk. They cannot do that. Apple has to be there. They have to have done that. They have to prove it. You know, they prove it. There's too many eyes on Apple. I think they're just a very different situation. So I think they were smart. And it's also, you know, it's hard when you're the last person. Like, every firm has mentioned it 1,000 times. Now Apple's going to step in, and as the biggest company in the world that doesn't really have much behind it, start talking about it. I think it would look cheap. I
want to get back to the LK.
It's like Tony talking. It's like you or Tony trying to talk about, you know, like, I don't know, like he was talking before about certain things that he really doesn't have any expertise on. But if he was talking like
a Shiva,
right? Yeah, you know, certain traditions that he's not that familiar with. But, you know,
I could talk 7 fishes. I can't talk Shiva.
You could talk 7 fishes. Yeah, you could talk all the Brazil you want. Yeah, but you can talk Brazil till we're blue in the face, but you can't talk Shiva.
It's funny you mentioned Brazil. I asked my wife to make that. LK99, the author said it's fake. This fake, like the video he played was fake. I cannot believe it. I feel duped.
I feel duped too. There's actually, speaking of dupe, there is a Harvard professor right now who's going through having her time on the barrel, shall we say, because she made her career on research about how people can get away with faking data, and apparently all of her seminal research was completely faked itself. So there is an interesting impulse making its way through academia where we kind of fake it until we make it. Now, this LK99 thing, obviously, if maybe the samples were pure enough, the tests early on show that it takes a lot of lead, a lot of copper to even get a very small sample that could be workable. And so we're not out of the woods yet. Like, the story isn't finished, but for my friends out there who are getting really amped up about flying cars, I have to say that this may be one meme that fades quickly. I've been looking at the American semiconductor stock recently, and it certainly has come back down to earth. AMSC, which when we were speaking last week had posted a 60% gain, was trading up closer to about $17 a share, is now back down to $9.14. Perhaps people wised up to the fact that it does not make these type of room temperature, these ambient superconductors. It just has the word superconductor in its stock name.
That's good. That's good. That's good. All right, Mr. Vecchio,
Good job out of you.
We're a little past the number here. It's 9:04. Thank you so much, and we'll see you later on today on the network.
Gentlemen, good to see you as always.
Thank you. We'll take a quick 90-second break and come back. We got more Tasty Live after this with the market measure.